today's report, the 15th of November 2024. Now, today I'll talk a bit about the Federal Reserve and inflation outlook, navigating renewed inflationary pressures. A bit about the current inflation trends. Now, in the latest CPI inflation report, it shows inflation has risen for the first time since March, with headline inflation now at 2.6%, up from 2.4% last month. Core inflation, however, remains steady at 3.3%. Now, this renewed inflationary pressure shifts the focus to the Federal Reserve's upcoming interest rate decision, scheduled for December 18, which will determine whether the Fed continues its rate cut or pauses. Now, because of this development here, the December Fed meeting, right? This is going to be a very important meeting. Okay, so with inflation still above the Fed targets of 2%, concerns have emerged regarding whether the Fed didn't raise rates high or long enough this time to control inflation. Now, since September 18, the Fed has shifted towards a looser monetary policy, lowering the Fed fund rate from 5.5% to 4.75%, with a potential additional cut to 4.5% expected in December. Now, with regards to the future Federal Reserve action and market expectations, right? So the next Federal Reserve meeting is scheduled, like I mentioned earlier, for December 18, raising the question whether the further rate cuts will be enacted or if the Fed will pause. So market expectations based on CME Fetch Watch 2 were as follows before and after the CPI report. Pre-report odds, 60.3% chance of a 25 basis point cut, 39.7% chance of a no change. Post-report odds increased to 82.5% for a rate cut, as market believes inflation has not risen enough to deter further easing for 2024. Now, expectations for the Fed's January 29th, 2025 meeting, however, only showed a 27% chance of another rate cut. Now, since October, inflation has been on the rise. With the Fed likely to cut rates again in December, projections for rate cuts in 2025 could shift significantly. If the Fed misjudged the timing or extent of these cuts, there's a real risk of further fueling inflationary pressures, potentially leading to an accelerated rise in inflation next year. Okay, so they have to manage properly. So what we're seeing over here is that, yes, this year they are following, but next year there might be some changes. So what are the economic implications of potential fiscal policies? Now, looking ahead, economic policies proposed by Trump, including tax cuts, higher tariffs, and mass deportations of undocumented immigrants, are expected to influence inflationary trends. Now, these policies could lead to stronger inflation in the months ahead, although their exact timing and magnitude remains uncertain. So what's the investors' response and bond markets and the US dollar impact? Investor sentiment reflects concerns over potential price growth, with sell-offs in government bonds observed over the past week. Anticipated inflation is causing investors to offload bonds as rising inflation diminishes the value of fixed bond payments. So basically, they are also looking to sell right now and buy those that are further in time as well. That's why you see the yield is actually rising as well, right? Consequently, this bond market movements has pushed borrowing costs, including mortgage rates, back up, counteracting the Fed's recent rate cuts. Now, the US dollar also continued its ascent, with speculations on smaller rate cuts in 2025. So this is what we are seeing so far. So conclusion, while certain policy initiatives such as tariffs may lead to temporary spikes in inflation, the broader inflationary impact of these policies remain uncertain. Now, this is Trump's second term, right? And he could just change things, and he also has, I believe, a better set of advisors than before. So the Federal Reserve response in December meeting will be critical in setting the direction for inflationary trends going forward, with investors and economy closely monitoring both fiscal and monetary policy shifts. Okay. So right now, this is what we think, right? Is going to go up with him coming in and saying, putting in all the tariffs, the deportations, and whatnot. Now, when it comes to deportations, right, it's going to affect those industries that that employs a lot of workers. Other than that, it's still okay. So we need to look at those kind of industries first of all. And with regards to whether it's going to push up, now what's happening is that in the short term, due to the anticipation, people might um the businesses might react to it, but in the longer term, we still need to see, because Trump is going to balance. He knows very well if he were to put in tariffs, things will be more expensive. But if he's able to increase the wages, that in a way could wages and also spending power, that could also offset the higher prices, right? So next thing we need to see is a wage growth under the Trump's administration, number one. And number two, he's going to also increase the spending power by cutting the tax. So if he can manage that well, then the tariffs may not be a big effect on the market. But how is he going to do it? Let's wait until January when it comes to power, and then see how things move from there onwards. Okay, so that's explanation so far that we have here, and with that, that's a report for today.